A warning to all investors. The bond market is calling the Fed's bluff, and inflation is surging as the Fed scrambles to regain control. So here's what's happening and what you should be doing to your portfolios. This year, the Fed has cut rates by 100 basis points, from 5.5% to 4.5%. But meanwhile, the 10-year Treasury yield has surged by 100 basis points since September. This is causing a major disconnect in the markets, signaling that investors don't trust the Fed's ability to manage inflation, and this is largely due to the Fed itself saying that inflation is likely to be higher than they once expected, raising their PCE forecast from 2.1% to 2.5% for 2025. This puts the Fed in a tough spot because if they cut rates too much, inflation will ramp back up even quicker than they are expecting. But if they keep rates higher for longer, the job market will be at greater risk than it already is in. Although the unemployment rate is not at alarming levels yet, we went from lows of 3.2% in 2023 all the way to 4.2% in November. And if this trend continues, the Fed will have no choice but to cut rates to try their best to avoid a recession. So it's clear that the Fed really has no clue what to do. I mean, just last month they implemented a jumbo rate cut of 50 basis points off of rising unemployment fears, yet now they're signaling that further cuts may be off the table due to rising inflation concerns.